Hi guys, I was just having a little technical difficulty here. All right. So let me go back to my slide. Bear with me. All right, so we are dealing with the types of stakeholders. And of course, we spoke about one aspect.
2 minutes for the participant to keep going.
Give me a thumbs up, guys, if you all are hearing me. All right, good. So we were looking at labor unions and we spoke about one aspect as to why labor unions would be interested in the financial statements or financial information, okay? They need to know that if a business is doing very well financially by looking at the financial statements, that they can ask for increased wages or salaries for their members. The labor unions would also be interested in paying compensation and benefits to union members who they represent. So compensation meaning that, let's just say a worker gets injured on a job, the labor unions would now more or less go to the business and of course try to seek compensation for that worker who has been injured, or more or less, I'm just still having a little problem here. Or of course, if it is that there are benefits that should be given to, let's just say, people who are more or less in the area of receiving a pension. Let's just say we have like senior citizens or people who have given the job 30 years of service, worked for the company for 30 years. They would need to know that when they go home, they are going to be given a benefit plan, which is more or less a pension. All right. So the labor unions would be interested in increasing employee salaries. They would be interested in paying compensation to their members and also to people who are more or less going home after giving a full amount of years of service to our business. All right. Then we have another external stakeholder, the government. And I will just put that briefly because I'm looking at time is going here. We have government, and they need to know the amount of profit being made so that an accurate assessment can be made of tax due. Now, it's important for the government to see the financial statements or financial information pertaining to a business. If a business, like for instance, we have had the pandemic, all right, where a lot of businesses did not make money. Obviously, if you did not make money, you did not make a profit in your business, it would be really cruel for the government to come and tax you on money that you have not made. So the government will only tax you based on your profit that you would have made from your business. The other stakeholder are competitors. Now, you might ask yourself, why competitors are stakeholders? They're the ones who are competing with us. Why are they a stakeholder? Well, yeah, they will be a stakeholder because they need to be able, if it is a business is in a particular type of business, so let's just say food business, two businesses selling, let's just say hot dogs, and one business, a hot dog business, is doing pretty good, all right? And of course, if it is, there is information where the business is making a lot of profit, then the competitor would now want to see the financial statement of the business that isn't doing very well. All right, sorry, of the business that is doing well, so that they can now get ideas as to what it is they're doing wrong. Or they need to be able to say, look, listen, we have to find a way to boost our sales. Okay, we need to market more, we need to advertise, whatever that is necessary. They need to be able to compare the financial statement of one competitive business with another to be able to assess how well they are doing as a business. And the last one we are looking at is the general public or the local community. They would be interested, and there is where each of you would now be able to be a stakeholder, because you belong to the general public or you would be in a community. All right, you will need to see how well a business is doing, all right, in order for you to probably seek employment when you are looking for a job. All right, so I have touched on the external stakeholders. All right, and now we are going to just look at a simple, well, you have a question here where you can now, I can now get an assessment as to how well you've understood what we have done. All right, so I have like 10 definitions. And of course, you're going to look at each of the stakeholders. The names are given to the top there. You have been given external and internal stakeholders. And you are to indicate to me which one of them fits the definition that is given there. Okay? All right. So once you have completed it, I'm going to give you just about 15 minutes, might be a little too long, but I'll give you 15 minutes for those of you who would want to double check. You're going to get 15 minutes to, all right. And we will provide the answers to these questions next day. All right. What is he angry about? All right, guys. So looking at the questions here, I actually would give you the answers for these this evening. It's a part of revision for you. So after the 15 minutes, let's just say around 7 o'clock, I am going to give you the answers for these definitions given. Okay? All right. Okay, so guys, I'm coming back again because I saw where I had another. Okay, Zakia, you've raised your hand. Okay. Just a minute, guys. Let me see what this Zakia. All right. So what you can do is also take a picture of this question. And as well, I'm going to give you the answers to this question. All right, as well. So you can get started. I'm going to give you just about, well, of course, now it would be 20 minutes I will give you. All right, so I will pause you for like 20 minutes. Please have your okay, guys. So we are going to start correcting the first part of the exercise, okay? For the ones that you would have gotten wrong, I'll just give you just about, what? A second or 2 seconds just to correct it, okay? So number one, your answer is customers. Customers are interested in knowing whether a company will be able to honor goods as they need them. So your answer for number one is customer. Number two, your answer is bank. Number two, your answer is bank. So banks evaluate the risk of lending money to businesses. Number three, your answer is trade unions. Number three, your answer is trade unions. They decide if the business has the ability to pay increased wages and salaries to its members. Okay. Number four, your answer is suppliers. Number four, your answer is suppliers. Number five, your answer is investors. Number five, your answer is investors. Number six, your answer is employees. Number six, your answer is employees. Number seven, your answer is owners. Number seven, your answer is owners. Number eight, your answer is competitors. Number eight, your answer is competitors. Number nine, your answer is general public. Number nine, your answer is general public. And number 10, of course, your answer would be government. Number 10, your answer is government. All right, so we're going to look at the second part of the exercise. All right, I hope you all would have gotten at least more or less 6 to 7 correct, or all. All right, so those are your answers. I'll just recap. Number one, customers. Number two, banks. Number three, trade unions. Number four, suppliers. Number five, investors. Number six, employees. Number seven, owners. Number eight, competitors. Number nine, general public. And number 10, government. Okay, so we're moving on. Question. Jerome has just opened a business selling fresh fruit from a market stall. He does all the work himself and he has supplied all the finances to set up and run the business. All right. The question, identify one internal and 3 external stakeholders who will have an interest in the business. Okay, so let's look at our answers. Identify one internal, okay, stakeholder. And of course, the internal stakeholder would be the owner, who is Jerome, sorry. Okay, the internal stakeholder is the owner, Jarrell. And we are to also identify 3 external stakeholders. So we can have either the supplier, the customer, competitors, anyone you can choose from the list that I had given you. And of course, we're going to state the interest in the business of at least three external stakeholders. So what I will do, I don't know the 3 you would have chosen. So you will have to listen attentively, and based on the one that you would have chosen, you make sure that you have the interests written properly. All right. So you have to state the interest in the business, of course, of 3 external stakeholders. So we're going to look at the first one. For those of you who have chosen suppliers, all right, of course, a supplier is an external stakeholder. Why? What makes him have an interest in the business? He will be concerned as to whether payment for supplies will be made on time. All right. So the supplier, whoever it is that is supplying goods to the business, he will want to ensure that payment for supplies will be made on time. So for those of you who have chosen suppliers, that would be his interest in the business. He will want to make sure that payments are being made on time. All right. For those of you who have chosen customers, they would be concerned as to whether the business, their interest would be to ensure that the business will continue to provide goods when the customer needs goods. Okay, so the customer would be concerned as to whether the business will continue to provide the goods when they need it. All right. So listen attentively to your feedback, because I don't know what you would have chosen. Government is an external stakeholder. And why would they have an interest in the business? They will need to find out how much profit the business is making. And that would, based on the profit, they would know how to tax that business. All right. So they will need to find out how much profit the business will be making, which will more or less be taxed based on the profit. The competitor will take an interest in the business because they will need to compare the performance of Jerome's business with their own business. right? To perhaps to get successful ideas. Okay. The local community. For those of you who would have chosen local community, they would be interested to know if Jorel's business have any effect on the local environment. For instance, if Jerome has fruits, or with however he disposes of his fruits that have spoiled, they would not want to know, or the community would not want to know, that Jerome is disposing of his fruits, in a place where it will encourage flies and all of those rodents. He will definitely have to dispose of his fruits properly. And that is why the local community would be interested, all right, in the business. As well as they would also be interested in the business. The local community would be interested in the business if it is Jerome can provide employment opportunities for them in the future. All right, or even to contribute to community development activities. All of those information or the interest that would be taken, right, based on Jerome's business. All right. I guess we have touched on, let me see, is there any more we should have touched on? Okay, so that's just about it. I hope that you would have gotten a feedback on this question here. It is not a feedback that has to be a specific way. If you use your instincts and you put yourself in the position of Jerome, or let's just say you put yourself in the business, in the position of the supplier or the customer or the government, the competitor, you need to be able, if you are thinking reasonably, if you are able to think and give a feedback that is encouraging, of course, you will get your mark. All right, once your feedback makes sense. All right, so now I know that I mentioned to you. All right, let me just go to the other slide. Now, I have given you a slide here, of course, which is what you can upload on YouTube. All right, and it's quite a lot, so I hope you are able to see this slide clearly. It is for your own reading. All right, traditional and emerging careers in accounting. It tells you, just a minute, hold on. I am just looking to see. Just a minute. Okay, so we have careers as a bookkeeper, and these are some of the duties and responsibilities of a bookkeeper and the skills that are required. It's very straightforward, so you can read it, and next day we can probably just go into it a little more in depth so that I can have an understanding as to whether you understood what you've read. Of course, this is also the career of an accountant. Again, it's for you to read, okay? It's difficult to type all of these and put it on a slide, so I have it here for you to read. Moving on. we're going to look at the accounting cycle. All right, we don't have much time, but this is more or less another area of accounting. All right, that we are going to look at quickly. I know that we can probably just touch on it quickly, and because we don't have much time, and I do not want to bombard you with too much work at this point in time, but we do have time. So let us look at the accounting cycle. The accounting cycle is the name given to the sequence of events and processes that are used to develop the financial records of a business. The cycle is made up of the following stages. So when you hear the word events, think of transactions, okay? Think of transactions. And for those of you who are listening attentively, let me just tell you what is a transaction. I don't know if I can call it out for you to just write it because I do not have it on a slide. So let me just tell you what is a transaction. So what are transactions? So I'm going to read it slowly and you can write it. Transactions are those activities of a business which involve the transfer of money, or goods or services between two persons or two accounts. That's a transaction. Okay? So the accounting cycle is the name given to the sequence of events and processes, events being transactions, all right? And of course, transactions are like the sale of goods, the purchase from suppliers, all of those are considered transactions. And processes are more or less all of the paperwork that is involved in putting your accounting together. So it's all the processes that are used to develop the financial statements or financial records of a business. So this is how, if it is, you were to ask me, how? I mean, we know what is accounting, right? We know who are the stakeholders, and we know what is the reason for them wanting to know about the financial information of the business. But the question is, do they just wave their wand and just get information just like that? No. So there are stages that must be looked at by the bookkeepers before it reaches to the accountant to do the accounting information. So how do we get this information? Of course, there are stages or processes that must be followed in order for financial information to be provided. So the first stage, the collection of source documents that provide details for financial records. So we spoke about the sales invoice. Those are source documents, the sales invoice, the purchases invoice, cash receipts, credit notes, debit notes, time cards. all of these, I will give you a definition of. It's when I give you the other slide, you are going to see what are these examples. Okay, I have it there on a slide for you. The other step is recording transaction in the books of prime entry. Now, the prime entry, books of prime entry are also known as original books of original entry. They are also called subsidiary books, or they are also called day books. So any one of the names used, it is one book they're talking about. Okay, the books of prime entry. The books of prime entry could be any one of them, original and books of original entry, subsidiary books, whatever name they use, you know what they're talking about. So the sales day book and the purchases day book, the cash book, the petty cash book, the returns inwards book, the returns outward books, the general journal. Now, another name used for books of prime entry, they refer to it sometimes as a journal. All right. So really and truly, all of these here are the books that would more or less contain all of the source documents. When you have classified the information, you are now going to be able to put it into the respective books using the source documents. The third stage is the posting the information shown in the books of original entry to ledger accounts. Now, I know that the ledger, it's something that you will not understand right now, but as time goes by, you are going to understand it. All right. Posting requires the classification and summarizing of transactions into an account. The book which accounts are kept is called a ledger. All right. So once the information from the books of prime entry has now been recorded, whether it is the purchases day book, is they have all the information, or more or less the journal, the name, whatever name they use. Once the purchases day book and the cash book and the petty cash book, once all of these books, let's just say, provide a figure at the end of a particular month, it is now posted to the ledger. The ledger is just a big book that has all of the accounts of the purchases, the cash, the petty cash, all of the accounts are in this ledger, but of course it is being separated. You are not going to mix your cash book with your purchases day book. Every account will have to be stated. So if you are dealing with the total for the purchases day book, it must not contain information pertaining to the sales day book. All right. It must only have in the purchases account, which is in the ledger, it must only have a total for purchases. Okay. And as we go along with our accounting, you will see what I'm talking about. Okay. So that is number 3. Number 4, the preparation of the trial balance. So it's important for you to learn this accounting cycle, because I've seen time and time again where examiners will ask you to list the stages in the accounting cycle. All right. So the 4th stage is the preparation of the trial balance. You will not know what the trial balance is now, but when you refer to your notes after we have reached that point, you will say, oh, good, I have an understanding of it. But the trial balance is more or less a statement, all right, where all of the information pertaining to what is in the ledger is now recorded in more or less whatever order you have it in the ledger, and you are going to check for the accuracy. So you're going to have in the trial balance debit and credit columns. Again, you will not understand yet, but as time goes by, you're going to see where in a trial balance, in order for you to know if you have recorded all of your information in the ledger, correctly and you have brought down the correct balances, you use the trial balance to see if you have done your accounting posting correctly. Okay? Both your debit and your credit column must have the same figure. Again, when you put it into practice, you will have an understanding of it. That is stage 4. And the last stage is the preparation of the final accounts and balance sheets. So you're going to have the profit and loss account, or also known as the income statement, and you're going to have the balance sheet. Again, we do not know too much about this, but from your trial balance, you would be able to prepare an income statement. And of course, from the income statement, you will now be able to go to your balance sheet as well. All right. So these are more or less the 5 stages in the accounting cycle. And of course, I've given you the cycle here. What examiners do is they would have the circles for you, and they are going to leave the information like collecting source documents, listing details in the books of original entry. They're going to leave out all of that, and you will have to write it in. Okay? So be very mindful as to the stages. Okay? And that's about it for today's lesson. All right. I need to get feedback from you all. Okay, just now I'm just seeing. So guys, you can go on YouTube. You would be able to access this video. And if you have any questions, next day we are going to address those questions. All right. I hope you would have learned a lot from today's session. All right. Have a wonderful evening, guys. Take care. Bye-bye.